We are now starting our Before Week 10 lecture, which we will be covering the bottom half of the assets, otherwise known as the long-term assets. Last week we looked at the top part of the assets, our current assets, and then the 2 weeks before we looked at the inventory, and then specifically looking at some revenue and expense items, some new items called sales return and sales discount, and then also our cost of goods sold when we sold the inventory. So this, our final week before exam 2, we're going to take a look at the bottom half of the assets. The first thing, to start us off with something kind of a review, just like when we talked about our inventory, when you buy an asset, a long-term item, any of the costs to get it ready to use or sell needs to be included in our purchase price. So just like what we did with inventory, and we did this example when we bought items from Ring Bling or the Auto World, when we bought things to go into our store like a computer, that kind of a cost, like a tax or shipping, that gets included. So if I bought something for $5,000 and then there was $500 in shipping, I would put that item on my books for $5,500. I don't separate out the shipping at that point. I can't put everything together because that is a cost to get my item ready to use. Now, so that's the first thing. The second thing that we talk about in this chapter is once you buy an item, there's a good chance that at some point down the road, you're going to need to do a major overhaul to it, a pretty big fix, something that's going to make it last longer, make it work a lot better, maybe even change what it does completely. If that happens, we call that a capital expenditure. So a capital expenditure, and basically if you answer yes to any one of the 3 questions here, then you're talking about a capital expenditure, and we'll talk about what that means in just a minute. So does whatever you bought to the asset extend its life? So think about a car and putting in a new engine. Putting a new engine pretty much is going to make that car last longer, most likely. Without the engine, it's probably not, without getting that new engine, it's probably not going to last very long at all. So we would answer yes to that question, and therefore that would pretty much guarantee us that this is a capital expenditure. We could also look at, does the engine increase the car's value? A lot of times with a big purchase like that, it would increase its value, like putting on a new roof of a home. That's going to make your home more valuable, and you'll be able to recoup some of that cost. So that would also be a yes. So even if I didn't answer yes, I got a yes here. So therefore, I've got 2 yeses, meaning this is almost definitely a capital expenditure. Now, what I mean by, the wording here is probably off. I should say change its capacity. What I mean by that, change its capacity, if you put a new engine, unless that was a super high-performing engine, like a racing engine, then that would be changing your vehicle's capacity, what it normally does. Normally it's a transport vehicle maybe, but then you put a racing engine in there, now it's a race car. So that would be changing it to completely something different. And that, of course, doesn't happen here. So you don't have to answer yes to all of these, but at least one. If that happens, we call it a capital expenditure. Notice I didn't use the word expense, we use the word expenditure because yes, we are paying for something, but we don't include it in our everyday expenses. What we do is we actually debit the actual asset that we bought many years back, and we up that asset's value. So when in the case of buying a new engine, as you can see what I did here with my little example, say 2 years ago I bought this vehicle. So of course I would debit the vehicle as an asset and then credit however I paid for it, say cash. And then now I bought a new engine. Instead of saying engine expense, I wouldn't want to do that because that doesn't answer back to week 1 the rules of the expenses. Remember, expenses are, we're using it right now, and yes, we would be using the engine right now, and we're only using it for just this year, and that would not be the case. That engine hopefully will last me more than just this year. So therefore, we've got to include it as an asset, as something that needs to be depreciated over its entire life. And what we do that, and then also instead of creating a brand new account called engine or vehicle engine, we just lump it into our already existing vehicle account. So therefore my vehicle would be listed at that, after we bought the new engine, for $22,500. And then also at that point, as we'll discuss here in a few minutes, we would have to refigure our depreciation for that vehicle, because now the vehicle A is going to last longer, so I have a new useful life, and B, it has a different starting point. It's no longer $20,000 being depreciated. It's now $22,500 less whatever I've already depreciated. So whatever I still have on the books for that vehicle's asset, that vehicle's worth. So I'll give you a couple of items here of what would be a capital expenditure. And then the other option then, if it's not a capital expenditure, it's just a normal everyday wear and tear expense. So yeah, wear and tears make it last longer. You've got to fix those, otherwise they're not going to, the vehicle or whatever it is isn't going to last as long. But they're not major repairs. They're not major overhauls. So having an oil change, even to the point of putting on new tires. Though sometimes tires, depending on the business, may only last you a year. So even though you think, well, tires may last me more than a year, most of the time we go ahead and write that off as an expense. It's a pretty low dollar item, and it's not going to increase the value of your car very much, if at all. Now, when we talk about long-term assets, we have the PPE items, property, plant, and equipment. Plant would be our buildings. E would be our equipment. We talked about the E. The buildings, there's nothing really big about that, and we don't talk too much about those in this class. But one of the things I do want to mention is the first P, the property, which is also known as land. The one big thing about land is it is something that in accounting does not depreciate. Landing does not depreciate. And that's my key thing here that I have. What happens in accounting, it's deemed that just because you have a building on a piece of land, that doesn't devalue that land over time. 100 years from now, that land is still going to be there and still going to be usable. Whereas a building 100 years from now may not be there and most likely will not. Or if it is, it'll be in a lot worse shape. Whereas the land should be, as long as everything was just used normally, land should be in just as good a shape. It's still going to be worth the same. Now, there can be some exceptions to that. Whereas if you actually use the land as part of your business, like natural resources, you're going in and mining or something like that, taking out trees, whatever it is, taking out dirt and rocks, then that's called depletion. And that's something different. Depletion we're not going to get to in this class just because it doesn't happen all that often with normal type small businesses. That's for different specialty type businesses. So the one other thing besides land not depreciating, the only other thing is, just like with our normal assets, land, any costs that get that land ready to use gets included in the purchase price. So even things like attorney fees, instead of calling that a legal expense, for example, if we bought a piece of land for $4,000 and then had a $500 legal fee that went along with that to make sure all the paperwork was in order, that land, I would put it on my books as not just $4,000, but $4,500, because I'm incorporating that legal cost into the price of the land instead of expensing out that legal cost right then. Because I'm probably not going to have that legal type cost year in and year out. Your expenses are supposed to show your people looking at your books what kind of costs are you incurring on a normal basis to increase your revenue. The purchase of land and using an attorney for that isn't going to be probably a normal every year expense. So that's why we put that in, we just include it in the land cost. The one exception, it's not really an exception, it's just a difference, is with the land. Land doesn't depreciate, but anything you do to improve the land does depreciate. And it should make sense. Anything you put on the land, like a fence or a parking lot or landscaping, all of those type of goods, yes, they're going to last you a while, but they're not going to be there forever, like just the plain old dirt will be. So therefore, we do depreciate land improvements. Parking lots, maybe that'll last you. You plan on having that last 15 years. So whatever the cost of putting in that new parking lot will be depreciable. Okay, now the big part of this chapter, where we're going to spend most of the time, is the depreciation methods. How do you depreciate in accounting? What are some of the different methods? We're only going to look at two here. There are others. There are other methods. There's one that's specifically just for tax purposes, but I'm not gonna look at those. That's we do that actually in our tax class. Another one that's sometimes used is called double declining. We're not going to look at that one either. I just wanted to look at two, probably the two most common. By far the most common is the straight line. We've already done the straight line method in class. When we were just depreciating a normal, say, piece of equipment, remember I had to used to give you with an adjusting entry, that piece of equipment's going to last us, say, 10 years. And if I bought it for $10,000, that means I'm going to use it $1,000 every year. I depreciate it means I use it 1/10 or 1,000 every year, so that's what I need to expense. So the two things that you need to know when you do straight line method, we've already done the first part. You already know how to do most of the straight line method. The only new little thing that we need to also know at this point is a term called residual value, also known as salvage value. They mean the same thing. They're synonymous terms. So if you hear me say one or the other or the book, that's the same. It means the same. The residual value or salvage value is how much do you expect to sell your asset for when you're all done with it. Because generally when a business is done with their asset, it still has some value. It's not completely worn down and completely useless. They can still sell it. So when a company depreciates something, they want to remove that cost, that how much they think they're going to sell it for after 10 years, whatever it is. And they want to remove that from the actual cost before starting to depreciate. And you'll see why in just a few minutes when we do what's called an amortization schedule. But essentially the whole goal, when I go to sell something in 5 or 10 years, whatever it is, I would love it. The best case scenario is if I can get my actual, what's left of my value of the asset, what's called the book value. I would love it if my book value equaled what my selling price was. Because if that happens, then I no longer have a gain or a loss. I will not have a gain or a loss to report. And that's best case scenario if you can avoid having a gain or a loss. You might think, well, gain's great. Well, can be. Just depends on how much you've depreciated. If you depreciated very little, then you're probably not going to have a gain. But if you depreciated a normal amount, then you may have a gain, and that just means you sold it for more than what it's valued at your books. Doesn't mean you made extra money by any means. That just means maybe you depreciated it too much, too fast. So having a gain doesn't necessarily mean it's a good thing. It doesn't mean it's a bad thing. It's just there. All it is a comparison. So what we do when we are going to do straight line, we only have two steps. The first step is the new step. All you want to do is take the cost of your asset. Remember, say my asset was $10,000. And let's say I had a salvage value of $2,000. I expect that after the 10th year, I can still sell this machine for $2,000. Therefore, I'm going to take the $10,000 minus the 2, and I'm actually going to start using my base value would be $8,000. When I depreciate, I'm only going to act like the asset's worth $8,000. And it's really worth 10 on my books, but I'm going to act like it's only worth 8. So when I depreciate it, I'm only going to depreciate that entire 8,000, leaving me still 2 left on my books. So I would take that 8,000 and divide it by the useful life of 10 years, leaving me $800 every year as a depreciation expense. All right, so let's take this out further. When I do that $800 of depreciation expense, that is for if I had the asset an entire year. Where in this example, that first year that I buy this asset, I don't have it for the entire year. I only have the asset for 6 months, the second half of the year. So when I depreciate that, at the time it's time for me to depreciate, I need to actually take that into consideration to say, hey, I did not have it for the whole year. Therefore, I can only depreciate it the amount that I had it of that year. So if I only had it a half a year, I can only depreciate it half of what the actual yearly amount was. So with this example, I'm buying a vehicle on a note for $19,000. I tell us it has a salvage value of $4,000 and then a useful life of 5 years. And what I want us to be able to do is I want us to calculate and prepare an amortization schedule or an amortization table. An amortization table is simply going to show me how much am I depreciating each year, and then how much do I still, what's the value of my asset when I net my cost minus the total accumulated depreciation. And so we're going to do the journal entry in the table here as we go through. So the first thing when I'm doing this amortization table, I'm going to want to look at, remember our first step here is to take our cost. So I'm buying the asset for $19,000 and I subtract out $4,000 in salvage value. So that leaves me a depreciable cost of 15 grand. That's what I'm going to actually depreciating. So then I take that 15,000 and divide it by 5 years. So for every full year that I have the piece of equipment, I'm going to depreciate it 3,000 each year. Thus, if I only have it for a half a year, so July through December, instead of depreciating $3,000, I'm only going to take half of that because it was a half a year. So I'm going to debit my depreciation expense, credit the accumulated depreciation for $1,500. Now I can start making that amortization table that I talked about. And here's the beginning of it. Across the top here are my main columns. So on day one, the first thing that I like to put, and you don't have to necessarily have a column called depreciable cost. You could just have that up here as one of your headings. It says this because it doesn't change. The only reason it would ever change is if you, as we did before, had a capital expenditure, say a new engine put in, then this 15 would have to go up by that, whatever the new cost is. But if you don't have anything like that, then we wouldn't necessarily have to have this column. So on day one, of course, with my depreciable cost of 15,000, day one, I haven't used it anything, so my depreciation expense is 0. If I haven't depreciated, of course, my accumulated depreciation is 0. And then my book value, what the asset is worth on my books, 19, minus how much I've depreciated in total, 0. So my book value day one is 19. That's what it's actually worth. Remember, I don't want to get these two confused. This is what I'm actually depreciating on, but this is its actual value, the 19 to full. So when 2016 rolls around, I did my calculation up here, 3,000 a year, but I also remember that it's a half year, so I only take 1,500 this first year of 2016. So I only had 1 year, so that's of course then what my accumulated depreciation is. And if you're looking at T accounts, we would have our vehicle listed or whatever it is that we purchased at 19,000, and now we have a brand new accumulated depreciation, a contra account. So therefore leaving me a book value of those two combined of 17.5. Now an amortization table, what it does is it takes you down through every single year and shows you how much you still have on your books and what your depreciation should be every year. Well, your depreciation should be the same when you're using straight line. So in 2017, my depreciation is the full year. I had it all year 2017, so I took $3,000. If I took $3,000, that means when I'm looking at my T account, my previous $1,500 plus what I just added in, $3,000, that gives me accumulated of $4,500. Then, to get my how much is still on my books value, take my beginning cost, 19, and I subtract how much total I've depreciated, $4,500. 19 minus 45 does give me $14,500. And then as you can see, I can do that for every single year. And then you may look at this and say, wait, this was a 5-year equipment, but yet I see 6 years being depreciated. Well, there's a main reason for that. Simply because the first year and the last year were only half. Only half of a year was used in 2016, therefore the remainder of that half year is used at the end. The first January through June would be used in year 2021. So really I do have 5 years. And then what the neat thing is, look at the book value at the end of that 5th full year. I'm at what I wanted to be at, $4,000, which is the same as my salvage value, what I hope to sell it for, or what I thought I would probably sell it for. If I do end up selling it for $4,000, then I have no gain or loss, and I can just record that I made that transaction, that I made the sale, and we'll see how to do that. And everything works out, no gain or loss. So when we do sell that equipment, here's what we do. I would just go back to your normal week 1 debit credit question. Debit, what did the company get when they sold the vehicle? Well, usually you get one of two things. You get cash or a promise to be paid. And a lot of times that promise to be paid will be a note receivable. A note receivable because with big ticket items like that, they probably aren't going to pay it off within a month or two. So there's probably going to be interest, some payment terms. Then the credit question, why did I get the money? Well, you got the money because you got rid of your vehicle. And whenever you get rid of equipment, we would credit that. But whenever we get rid of a piece of equipment, we always have to get rid of its partner account as well. The accumulated depreciation is joined at the hip with the vehicle. So when you get rid of one, you have to get rid of the other one as well. Now what happens then is a lot of times we don't sell our vehicle for exactly what it's worth on our books. And in that case, we're going to end up with a gain or a loss. So as you can see here, I've got it laid out real easy. If I sold my asset at the end of this time frame for $5,000, so therefore my sell price, $5,000, is greater than what it's worth on my books for, I'm going to have a gain to report. But just the opposite, if I sell it for $2,000 and $2,000 is less than what it's worth on my books at $4,000, I'm going to have a loss to report. And where those are reported, they're treated very similar to an expense, but actually they go beyond the expenses into a brand new area of seldom used accounts, and these are in the 600s. They're in the 600s because they are seldom used and because we don't expect them to be a reoccurring type issue. Expenses are there and they're listed there for whoever's looking at your financial statements to get a good idea of what you spend on a normal year-to-year basis. Advertising is something you normally do to help your revenue. Wages, same thing. You have to pay rent. But it's not typical in a business to sell your assets all that often. And if you happen to have a loss, well, that's going to take down your net income. But we want our investors to see what was our income if I didn't have this loss there, because it's so unusual. I want you to get an idea of where I would have been if this never even took place. That's why it's out there on the end, and it's also the same way on an income statement. You'll have a line towards the bottom that says net income before gain or losses, before other activities, and it gives your investors or whoever it is an idea of where you're normally at. And then below that item, it'll show your gain or losses, and then your final net income, which may be higher, quite a bit higher or lower, depending on this one-time type transaction that happened. So when it's all said and done, when we have a loss, losses always have a debit balance, kind of like the cash short did last week. So losses are going to be very similar to an expense. They take our net income down. Gains are going to do the opposite. A gain's going to have a credit balance like revenue does, and it's going to make our net income go up. So if we look at the example from above, and we have $11,000 that we're selling our asset for, and we're going to say we sold it on the 30th of September 2018. The first thing I would need to do is determine how much depreciation do I need to take care of in 2018. Because if I look back to my amortization table, the part here in gray I've already done in prior years. I've already taken care of the 2016 partial year. I had it for all of 2017. But in this new year, 2018, I haven't done this entry yet, and I shouldn't have because I haven't had it the whole year yet. I'm now ready to sell my asset most of the way through 2018, but not completely all the way through. So instead of having it entire year, 3,000, I want to show it of how long did I actually have it. I only had it 9 months out of 12. So 9/12 or 3/4 of the full year's amount, 3,000. I need to show a depreciation entry on the day of sale or the day before of how much I used it for that year. Then I can update my amortization table to the correct numbers. The correct numbers say I really had this for an additional $2,250 for the year because that's what I depreciated. So therefore my accumulated depreciation before as of last year, it was $4,500 plus another $2,250. That brings me up to $6,750. Therefore, my book value, the $19,000 less my accumulated total, tells me what it's worth on my books. Now, I can tell if I had a gain or a loss real quick. If I sold it for $11,000, which is less than my book value of $12,250, I know I'm going to end up with a loss. So let's see how that works out then on our journal entry. So remember, when you sell something, ask your question, what did you get? What did the business get? That's our debit. We got cash. Now you think, oh, there's more debits. Well, just a second. Let's go ahead and do our credit question. What did I get? Cash. How or why did I get it? Because I got rid of my vehicle. The vehicle is no longer on my book, so I need to credit it off. And then remember, whatever happens to the vehicle, if you get rid of something like that, you also have to get rid of its contra. So because it's a contra account, it's going to be reversed. Typically, we would have credited if it was a normal type of account. But since it's a contra, it's backwards, so therefore we need to debit to get rid of that T account. And then at that point, we could go ahead and stick in our loss. Or we could look at it and say, hey, my debits, if you add up my debits, they don't equal my credits. My debits only equal $17,750. That doesn't equal my credit, so I know that I still have $1,250 missing, which happens to be the loss. And remember, losses are just like expenses. They're always a debit. They take money away from our income. All right. Let's move on now to the second type of depreciation. So we just did straight line and then selling an asset using straight line with a gain or loss. Now we're going to look at just a slightly different way of doing depreciation. The straight line method dealt with years. But if you have an asset that is based more on production than necessarily years, useful life, the units of production may be the better method to use. It's not that much harder. It's actually pretty simple once you get into it. And it may be more accurate as you go along. So for example, you have to have an asset that keeps track of how many things it does. And a car is a great example. A car keeps track for you how many miles it works every single year. And then you just got to jot it down how much you started with and then what it was at the end of the year to see how many miles you drove. Other machines do the same thing. It'll have a little counter on it that will tell you how many times it has produced or rotated or whatever it is. And then you can base your depreciation based on usage instead of years, which may or may not be accurate if you use it a whole bunch one year and then not very much the next year. So the only thing that management needs to be able to know They need to be able to calculate the salvage value again, which is the exact same as straight line. But you also need to be able to, what you need to do then, instead of saying 10 years, you need to say how many units am I going to be making, or whatever it is, going to be driving. And so in a car, it would make sense that it's miles. If I said I'm going to drive 100,000 miles, and I had an asset that was worth, say, $10,000, a car that was worth $10,000, and I'm going to drive it 100,000 miles, that would be 10 cents for every mile if you just did the division. And I'll show you how we do that. Let's go through it here, example. If I had an asset, let's make it easy, $12,000 with a $2,000 salvage. So that gives me a depreciable cost of $10,000. And then let's say I had total, let's make it 100,000 units, 100,000 miles. I expect to drive my car, or I'm going to depreciate it based on $10,000, 12 minus the 2, 10,000 divided by 100,000, step 2. Step 1 here was exactly the same as straight line. Notice I'm getting my depreciable cost. Step 1 on both methods is exactly the same. Step 2 is just then, how much am I going to depreciate every time I make one item or drive 1 mile? So 10,000 divided by 100,000. That tells me it's 10 cents per mile. Instead of jotting down and doing a journal entry every single mile that I drive, I could do that, but that would be a complete waste of time. Instead of doing 10 cents a mile, all I got to do is say, well, if it's 10 cents a mile, I drove for, say, 10,000 miles. Therefore, I'm going to depreciate $1,000. I took 10,000 times 10 cents a mile would be 1,000 a year. So let's look at my example here. We're using the same thing as above, where I had this asset. I bought it for 19,000, salvage value of 4,000, and a useful life of 5 years. So I expect to sell it for $4,000. Now everything's the same, except now instead of the 10-year, I don't really care about years anymore. All I care about is usage. So let's do our 3 steps for the units of production. I'm going to take my actual cost, 19. So this step 1 is the exact same as step 1 above for the straight line. I'm going to be depreciating everything over based on a $15,000 value. Then I'm going to take that value and simply divide it by how many miles am I going to be using this car over its life. And I expect to use it 150,000 miles. So again, that worked out just like my other problem to 10 cents a mile. So in the first year, if I drive 35,000 miles, all I need to do is just show 10 cents a mile times 35,000 miles. I'm going to do a depreciation expense journal entry for $3,500. That then leaves me a book value, the cost of my asset, what it's worth on my books, remember the 19, minus how much I've depreciated, just 1 year. Book value remaining is $15,500. Now, the easy part about this method is every year after year 1, all you've got to do is repeat step 3, because the cost of the asset doesn't change. We don't change that. We don't change the salvage value. Total units that I've estimated, again, that's an estimate. I don't change it unless something big's going to be changing. So that's going to stay the same. All I've got to do is just change the number of miles that I drove in year 2. So in year 2, I drove 40,000 miles, 10 cents a mile. I'm going to now do a depreciation expense of 4,000 in year 2. Notice up here with the 3,500, it didn't matter when I bought the asset. If I bought it in May or April or November, this is going to make that determination. Just how many miles did I drive? Doesn't matter how long I had it. So once I have this 4,000 depreciation expense, I can then get my new book value. Original cost minus how much I've depreciated in total. So 3,500 year 1, 4,000 in year 2. That's where I get the 7,500. Remaining book value of my car would be $11,500. Okay, we're going to do quite a bit more practice in class, and I will see you at that